We're going to be going over three stocks, and one stock is going to help us make about over $1,000 per month selling options. So we're going to first going over earnings whispers. As we can see on our screen here, not many companies are reporting earnings, so we're not really going to trade any of these companies. So we can go ahead and get rid of that. But the stock we're going to be looking at is T Triple Q. So this is the leveraged three times ETF of the NASDAQ, the normal QQQ, which is actually this guy right here. And so why would we trade a T triple Q over the normal triple Q? So this one, as we can see, is going to have a higher stock price at almost $300 per share, whereas this one is about a tenth of the price at only $25 per share. So it's going to be a lot cheaper, and for people with smaller accounts, they can trade this a lot more easily. And the thing about leveraged ETFs, they're mostly designed for short-term traders or investors. You don't want to hold these over long periods of time because you are going to get that decay factor. So, since we are selling options, this is a nice strategy for us to use the strategy on this stock. So, what we're going to be doing is selling some cash cure puts, and we're going to be going over a monthly option. So, let's go over to the sell the put side, and we're going to do an October 14th expiration date. And let's write on the stock prices. So basically, when we sell a put, we're obligating ourselves to buy 100 shares of the stock at our given strike price. And if it doesn't go below that strike price by expiration, the option pretty much disappears. It expires worthless, and we pocket the premium for our trade, and which is the optimal outcome. So we're going to be going all the way down to strike prices. We want to be a little bit safe. So we're going to be doing the $20 strike price for $84 a premium. Now, keep in mind, this is the weekend, so it is subject to change when the market opens. But for this example, let's say that we have $30,000 of buying power into our accounts. So we're going to be doing around 15 contracts of this ETF. Now, you don't all have to put all your money into one stock like this. You could diversify your portfolio a bit and sell options on different strikes, on different expiration dates, or even different stocks. So you don't have to do all these the same contract. So as you can see here, we're receiving a credit of just under $1,300, and that is going to be pocketed in 1 month. So pretty nice premium right here, honestly. And we're pretty safe as well, going down the furthest strike price at $20 per share, which is going to be around a 76 chance that this will expire out of the money, aka worthless, and we're going to be pocketing the premium for free, and we can continue month over month and selling some option premiums. So for people who don't want to do a triple leverage ETF, you can do it also on on the regular the Nasdaq QQQ. And for people who don't know, this is like the big hitting names, mostly the tech companies. So it is a pretty good ETF. This is going to be a bit safer than the other one, but downside is the strike price is going to be a little bit more costly because the stock price is almost $300 per share. So for this one, we can do something like a 286 strike price for, let's go to October 14th, the same expiration date, and we'll go. Let's see, the option premium is looking really good right now. We can do, I would say, 275 for $500 of credit. Seems pretty good to me. We can sell 10 of these. Not 10 of these. We can sell like two of these. In our collateral, as you can see, it's going to be 55,000. So not very feasible for people with large accounts. If we sell one of these, we're going to be making $500 in just a single month. Not very bad for the regular QQQ. It is a bit safer. So for people who want to be a bit safer, make some nice income month over month, you only need $27,000 to make $500 per month pretty safely. But of course, if you want to be a bit riskier, you can make $1,300 per month with only $30,000 of collateral. So another great ETF we can do the strategy on would be the ARK ARKK, which is Kathy Woods ETF. As you can see, it's down quite a bit, and it has been stabilizing the past few months. So this is a good opportunity to sell some puts on this ETF. You really want to sell these cashier puts during periods like this because you're most likely going to collect some nice premium. So same example, October 14th expiration date. We can go down the strike prices. Something like a $38 strike is going to be pretty good. And we can sell, for this, let's see what 10 of these give us. So we're going to be collecting $1,200 of credit on $38,000 of collateral, which is not that bad at all. Honestly, it's pretty good as well. So any of these three ETFs are great options. ARKK, we also have KeyQQ, and then we also have TQQQ, which is the main example this video is focusing on to collect some really high premiums and while protecting ourselves as well, because it is a lot safer than just outright buying 100 shares of the stock, because you could potentially get the stock for cheaper at $20 per share, which is $5 under the current stock price. So that's about it for this video. Thanks for watching.